Welcome back. You're watching us here on Halftime Report in our special segment Fund Race, where we speak about, everything that's taking place in the world of PE VC funding. We get in important voices as well. So Fundraise, is our special segment which we had started before the results season. And now that the results are done, it will be interesting to get some insights coming in out there as well. And speaking about those insights too, we have a word coming in from Deepak Shahdadpuri, the MD and founder of DSG Consumer Partners, among the earliest in, investing in a lot of these D2C brands. And we spoke about the recent urban slowdown, legacy versus insurgent brands, and where the funds are going. This, of course, is from the sidelines of the CNBC TV18 Global Leadership Summit.
With 1.4 billion people, with the growth in GDP, with the growth in per capita GDP, consumption spending will increase, but nothing goes up in a straight line. On the question of sort of legacy brands versus sort of insurgent brands, the data and the research we've done has shown that insurgent brands or successful insurgent brands grow on average 3 times faster than legacy brands. We target a more sophisticated consumer who's looking for something different, and the marketing and the sort of narrative for those brands are sort of exciting to the consumer. And again, think of the base, right? The base is small, so the growth rates are much higher. Legacy brands are large, but the base is huge. I think over the next 10 or 15 years, you will continue to see new insurgent brands sort of take market share from the large companies. And you'll see how large companies sort of navigate the space the same way they've done in the US and in Europe.
World over, there is a trend that insurgent brands are going ahead and acquiring legacy brands in all segments except the consumer space. It's in the consumer space where the power lies with and the cash lies with the legacy brands who go ahead and acquire brands, insurgent brands, which struggle to scale beyond a certain level. Do you think that happens here in India as well over the next 10 years?
It has happened and it will happen. And it's not only because insurgent brands are struggling. So think about Tata's acquisition of Ching's earlier this year.
Right.
Ching's is a highly successful, fast-growing, profitable brand. It wasn't struggling. It's just that the large incumbent brands, whether it's the Indian MNCs or the global MNCs, they have realized that consumers want diversity, they want different brands, and therefore, if you can't beat them at the game, either you have two choices: either start a brand to sort of compete with yourself, or acquire a brand that has competed with you and taken market share away from you. And what we've seen around the world is that the large strategics have continued to buy young insurgent consumer brands. And what's most interesting is they've started buying smaller companies earlier in their life. So what used to happen was if your revenue was sub 100, 200 million, the large MNCs wouldn't bother. That's all changing. So you'll see companies as small as 20, 30, 40 million now being acquired by the Unilevers, the L'Oreals, the Tatas, ITCs. It's coming, and you're going to see lots more of it.
As an early investor in some of these insurgent brands and, someone who looks at the space very closely, has been doing that for decades, if you had one piece of advice to give to the legacy brands and one piece of advice to give to the insurgent brands, to the legacy brands to grow faster and the insurgent brands to scale up a lot more.
I think brands have one job. Brands have to talk to the consumer, listen to the consumer, and work with the consumer. The consumers are telling you something. They want something different, something new, a change. So the ecosystem needs to work together. The best consumer brands, whether they are insurgents or the legacy brands, are now working in the same ecosystem. So you have the Unilevers, the Nestlés, the L'Oreals investing in legacy brands. Many of them work with us, invest in young insurgent brands, help them grow. They may or may not acquire them, but they know that if you do right by the consumer, in the long term it will pay off.
What about the near-term urban slowdown that we're seeing? Do you have a comment on that? You do speak to a lot of startups.
We are seeing it across our portfolio. The premium products continue to grow. There is a slowdown last 4 quarters across our brands in sort of the value segment. Again, I think sentiment is soft. It's been soft for 4 quarters. I think there'll be another 2 quarters of soft sentiment. But Indians are very excited. They are very positive. They are very bullish. We're one of the fastest growing economies in the world with a very large base. So it's a question of when. And when we have this conversation in 12 months, you'll ask me the other question: why are we growing that quickly?
While that is happening, there's also a function of how much, right? When is one question of the growth, but how much you're paying is another question. Valuations have been through the roof over the last, couple of years or so.
India has always been an expensive market. I started investing in consumer in India in 2001. I just come from London. And it took me 3 years to recalibrate my mind to the fact that every listed Indian company was trading at a 30 to 40% premium to the global multiple. Was that justified? It looks like the growth has paid off. So I think in the short term, given how excited investors are about India, things may have run, but I think the growth will catch up. But again, as an investor in early stage brands, right, we have a 10-year view. So whether you're paying a little more or a little less, the growth will sort of work out if you pick the right brands, grow in a very capital efficient manner, and not sort of, don't foie gras it. Don't take cash to buy top line, just build it sustainably.
All right, and final question then, 3 companies that you are betting on to be very, very big over the next 5 to 10 years. They may or may not have been in your portfolio.
You know, it's tough. The ones in my portfolio are the ones I watch very closely. But again, let me think. I'm very excited by Boat. It's not in my portfolio. It's a company I sort of saw and I passed on because I was sort of hesitant to do anything in the hardware space, but they've proved to be a fantastic brand. Consumers love them. I would say Veba, which is in my portfolio, very fast growing, got to 1,000 crores in 10 years, no debt. Watch out for what Veba will be doing as it sort of takes on not only other insurgent brands, but the legacy brands. And I think what is going to happen, I'm trying to think of something in the beauty and personal care brand. I think a Plum or a Sugar, because as consumers become wealthier, they spend a lot more on personal care. So I think one of the large sort of fast-growing Sugars or Plums of the world would be a company to watch out for.
I'm surprised you didn't name any of the QCOM players.
You know, QCOM to me, again, is a
All right, we'll cut out of that conversation. Also,